In our final story in Surviving the Squeeze series, this morning we're looking at how to navigate repaying student loans.
While there is that 6-month extension on the pause now, most borrowers will have to start repaying their loans at some point or another. 13 on your side's Trevier Gonzalez spoke with the experts. Trevier, where should people start?
Yeah, they say the best way to do it is honestly just to face it head on. And of course, that is easier said than done, but there are resources to help. And sometimes it's really just a click or phone call away.
It was back in 2020 when 28-year-old Abby Mitchell graduated from Grand Valley State with a bachelor's degree in psychology. Since then, she's been working in the mental health field. While she's making slightly better income than before she graduated, there are many times when she still feels like she's just barely getting by.
It's paycheck to paycheck.
Mitchell's debt, as of today,
My current balance for my student loans is $76,693.
a 2020 moratorium has been keeping her loan payments at bay, but eventually she's going to have to start making those payments.
I'm not sure how that's going to work out.
And she's not alone. Mitchell joins thousands of postgraduates who feel uncertain about the future. Right now, her monthly payments are estimated at $820 a month.
With rent, that's about $1,500 right now, and you add a car payment onto that, and then you add $800 onto that, and I'm spending more than I'm making a month at that point.
So what can you do to prepare? Mary Jo Terry with Y Refi says it's time to take a look at your student loan information. That can be done on studentaid.gov. From there, make sure you know your loan balance and interest rate. You also need to find out who your loan servicer is, as well as your monthly payment.
Once you figure out who your servicer is and what your payment is, you might want to check with your servicer to see if you're on auto debit, right? That's going to be important. It's been a significant period of time, coming up on 3 years, where payments haven't been made. And what we don't want to do is have money taken directly out of your bank account.
Going into auto debit gives you a 0.25% discount on federal loans, which can shave months off your payment plan. Terry says to explore what repayment program may be best for you. An income-driven payment, for example, looks at your household expenses and puts it up against your student loans and places you on a low monthly payment plan. For those with multiple loans, debt consolidation could put you on a better payment plan.
You can do all of these calculations on studentaid.gov or call your loan servicer. What we're talking about is 10 or 15 minutes. You can do it at any hour of the day. I know we all have extremely busy lives, but these pieces are extremely important.
Terry also suggests giving a little extra when you can. It means less interest you'll have to pay and possibly even shorten the length of your loan depending on how much you shell out. While debt isn't great, Terry assures us that skipping out on your student loan repayments is a whole lot worse.
Default is not a good option. Delinquency is not a good option. What ends up happening is everything in your life will become more expensive. If you default on your student loans, things as simple as your car insurance and the cost of that will go up because it affects your credit score. Your housing prices will go up because it affects your credit score. And we want to see you get this resolved and paid off.
And keeping those loans in good standing also keeps you eligible for loan forgiveness programs down the line.
Abby said she's thankful with the news of that extension. Of course, studentaid.gov is really the go-to when it comes to checking on your debt and finding out who services your loans. That line of communication might be the best way to prevent a whole lot of hassle.